Something you may have heard bandied around a lot amongst financial markets is the belief that every trade should always have a minimum risk reward of 1 to 2. So, for instance, here you might think, okay, well, if I was looking to enter the euro US dollar today at that big round number, big option expiry level, if I have my stops below the previous pivot point, I've got to make sure I get a 2 to 1 return, and if I get a 2 to 1 return, then yeah, the risk reward ratio is then I can take the trade. If it isn't, I mustn't take the trade. Now it's very easy at the first glance. I think yes, that is intuitive, and that makes complete sense. And one of the difficulties is that it seems so intuitive that to take something with a risk reward of less than 1 to 1 just seems stupid. You think, well, why would you risk, roughly the same? Um, because over time, then you have to have such a high win percentage that you're making it very difficult for yourself. Now, the truth in this is obviously, if you could take every trade, that had, 3 points, 4 points risk and, 20, 30 points upside, risk reward 16, 17 times, then of course, that's great. But you can also take trades when you have a risk reward of less than 1 to 1, but it's still mathematically sound. And that's where expectancy comes in. And it's something that's confusing. It's something that confused me when I first started trading and when I first started understanding fundamentals. There'd be a trade, you're thinking, yes, I've got a real good sense in which the direction of this currency is going to go in today. And even though the risk reward isn't perfect, I still can think, well, actually, I've still got a high conviction in this, and it still sort of seems logical to take the trade. And the maths behind that is something called expectancy. And so let me just show you how that works. So let's take a hypothetical example, right? Let's just look at the next, Canadian inflation print, right? So we've got Canadian inflation print coming out 21st of November. It doesn't matter if this, if time's moved on since reading this video, just get the principle. Let's say in the current market environment, if this inflation print comes in very high, in other words, above whatever maximum expectations are next week, then we have a high probability that we know that Canadian dollar is going to move higher, right? Now, what we can do is you can work out what that expectancy is. So here you can see. So say we risked, let's just say we're risking 1,000 units of currency, right? So they were risking 1,000. If does the Canadian dollar gain on hot inflation? Does the Canadian dollar not gain on hot inflation, right? So we can work out. So if it gains on hot inflation, what am I expecting to gain? Well, let's say I'm expecting to gain, let's say less than what I risked. So say I risk 1,000, and say I'm expecting to gain only half of what I risked. Okay, 500. And say that if the CAD doesn't gain on hot inflation, I'm completely wrong with a trade. Let's say I risk everything, I lose everything that I risked. Okay, so I risked 1,000 and I lost everything. Right now we look at the probability of the event. What is the probability? Well, if the Canadian dollar, right, if inflation is very hot, I would be extremely expectant for the Canadian dollar to gain because it would increase expectations for higher interest rates for the Bank of Canada. You'd expect the CAD to rise. So what probability? I would say it's 90% chance. So 9 times out of 10, I would expect the CAD to gain on hot inflation. And 1 in 10, I'd expect the Canadian dollar not to gain on hot inflation. Now, if I'm honest, I'd more expect it to be 95% of the time. I think that's a closer, a fairer expectation, right? So that means the expected value, and that is simply the division between D2 and C2. You can see that the expected value is 475 when you factor in the probability, and the expected value is minus 50 when you see it's only 5% chance of a £1,000 loss, and the expected value is 425. So on average, right, I'm expecting to get £425 from that trade where I've risked 1,000. So you see the risk reward is less than 1 to 1. It's like 1 to 0.5. But look at the expected value. The expected value is positive. So as long as that expectancy is positive, it means it makes mathematical sense to take these trades. So if you're taking these trades with a high probability, and you can see that the expected value, that is just the expected value divided by the at risk amount, you can see that the expected value is 43%. So that's solid. And look, I could even say I was going to get even less than what say I only risked 400. Say I risked 1,000 to get 400. Expectancy still positive. And say I did the same, and I'm going to get 300. So you expect to see it still makes sense for me to take this trade. Even if I'm risking 1,000 trying to make 200, if the probability of the event is 95%, the expectancy is 14%. That's positive. It's only when, so let's say even 100, it's still positive expectancy. Now, obviously, look, you got to use your common sense here. You don't want to be taking trades like this all the time, because it's just, you can, but you know what I mean. For 5%, what's the point? But you see the thing that is risk to reward is like not 1 to 10, it's 10 to 1 or 9 to 1, whatever it is. You get the point. It's a very poor risk reward ratio, but still mathematically it makes sense. So that's why you just got to know expectancy. Okay, I'll just put the formulas up here. Right, C2 times D2 gives you the expected value there. Make sure that's as a percentage. Then you've got C3 times D3, that's your value there. And then you've got here, that's E5 divided by B2. And the expected value is just expected value CAD gain plus expected value CAD not gain. Okay, so you're just adding those two together. And that's it. Then next time I'll show you thinking, okay, what do I think? Now, where's the weakness with this? Well, the weakness with this comes from what happens if you've got the probability wrong. Okay, what happens if you've misunderstood the data point and actually, instead of a 95% probability, let's say you were risking 500, but let's say you thought it was 95%, so healthy, but actually it was 70-30. Now look at your expectancy. It drops down to only just worth doing. So the devil, as it were, in this calculation is that probability of event. Now, you can convince yourself that something's almost certain when it isn't. Okay. So what I would say is that this is like a little bit of art rather than a science. So be hard on yourself. Okay. So here, for instance, CAD gain on hot, I think it's 95%, but let's say I'm going to give it 85%, just to give myself a little bit of margin for error. Okay. Maybe I was being a bit optimistic. Maybe I'm a bit enthusiastic. But still, it's worth doing. Folks, I hope that helps. And that should just give you a little bit of understanding on the power of expectancy.